Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Kaplinger, Marketing Specialist from ICBB. With so much economic uncertainty in the air, managing risk in your loan portfolio can feel like navigating a minefield. It's more important now than ever to move from a reactionary approach to a proactive one. I spoke with Michael Ware, a consultant and speaker at our upcoming Link event in Ohio, on how to do just that. I was joined by our Chief Lending Officer, Brandon Feltner, and our Correspondent Loan Officer, Nick Bigley. Please welcome Michael, Brandon, and Nick to the podcast. Hey there, community bankers. I'm here with Michael Ware, along with our Chief Lending Officer, Brandon Feltner, and one of our correspondent lenders, Nick Bigley. How are you guys doing today?
Awesome.
It's a good day.
Yeah, it's beautiful out.
Awesome. Well, thank you guys for joining me today. Michael, if you wouldn't mind I think you've been on the podcast before, but for those who maybe haven't heard your episode or aren't familiar with you, tell us a little bit about yourself and your career. And then Brandon and Nick, if you want to introduce yourselves as well, that would be great.
All right. We'll keep it short. Michael Weir from Omaha, Nebraska. We're on the East Coast of Nebraska. 41 years, retired banker, and moved up through the food chain of retail into commercial, into risk management, senior risk management. The last 8 years of my career, I worked for the largest family-owned private bank in America in the commercial real estate department. We're about a $4 billion department. So worked on some very large deals, including some in Columbus, Ohio area, which is a lot of fun to work on. And for 32 years now, I've been doing banker education through state banking associations, graduate level schools, and national schools, and a little bit of bank consulting and even a little bit of expert witnessing. The case that I worked on actually went to the Nebraska Supreme Court, so that was kind of interesting there, side note. But happy to be here. I've spoken before ICBB's conferences and enjoy the folks there. You have some excellent speakers and also some terrific staff. I've enjoyed working with them quite a bit.
Yes. My name is Brandon Feltner, as Madison said. I'm the Chief Lending Officer, and I've been with ICBB for 6 years. Actually met Michael Ware at Graduate Banking School in Wisconsin. Was fortunate enough to have him as a professor, and now to have him be a part of our show and be a part of our learning content here at ICBB, and just happy to be here.
I'm Nick Bigley, correspondent lender with ICBB. I cover the states of West Virginia, Ohio, and Indiana. Been with ICBB since September of 2025. It's 25 years in the banking world, 15 years in the commercial and business space, and really, just enjoy working with the community banks that we support and market.
Yes, and I think, Nick, this is your first podcast, so welcome. We will try not to scar you for life. No, I'm kidding.
Thank you.
We will try to scar you for life is what I was kidding about. No, not really. But yeah, so all three of these guys are going to be at our Link event in Ohio. Michael will be giving a presentation titled Moving Loan Portfolio Risk Management from Reactionary to Proactive. So Michael, just give us a little bit of a synopsis of what you're going to be talking about and why it's more important now than ever to be proactive in terms of the loan portfolio.
No problem at all. Reactive would be reflecting how the bank identifies risk, not in its classified and substandard special mention ratings, but in the pass rated portfolio. Oftentimes community banks recognize weakness via past due reports, loan covenant trips, overdrafts. Those are all lagging indicators. So what we're going to be talking about is moving more towards proactiveness, which is looking more at the external environment. And that is what we have going on right now. So the timing of this conference aligns very well with some very much economic headwinds going on right now. And also how to translate that into how will that affect our portfolio. And how to do that is what we're going to be talking about, giving some tools, giving some thoughts, giving some, ways that have worked in the past with the Great Recession, primarily early stages of that. It hit hard. So we were very reactionary there. So we thought, how can we be more proactive? So some lessons learned in the past, apply those today so that we hopefully can be ahead of the game. The worst thing about bad loans is that they're usually made in good times. And we all know that we've had very low delinquencies up until very recently. We have an upward trend going on right now, and very, very low charge-offs. It's been terrific. But again, complacency can set in very quickly. So we'll talk about those aspects also. And again, ways that management can talk to their lenders to ensure that we don't get too complacent. We do talk to our borrowers on a more often basis and the like. So that's what we'll be talking about.
Awesome. And it sounds like that's going to be extremely valuable for the credit and lending people that attend the event. And one of the tools I know that you've mentioned in other presentations is the credit culture self-assessment tool.
Mm-hmm.
So without giving away the whole rubric, because we want to leave something for the presentation, obviously, what's one red flag a CEO might find in their own culture that suggests they're stuck in a reactionary loop?
Emphasizing growth over quality. That's one right there. And that can happen. That can happen, especially with low organic growth. So I always like to see quality loans first, which fuels profitability. And then that can be poured into growth strategies. And then the disconnect between, let's call it the written policies, the written procedures of what the bank wants people to follow, and the actual behaviors. Sometimes those get disconnected. So loan portfolio risk management is kind of that intermediary between the two, and your credit culture is smack dab in the middle and takes all that into consideration.
Yeah, so it sounds like that's a helpful, red flag to keep in mind. You mentioned earlier that, there are some proven early warning indicators. A lot of bankers are reliant on things like past due and loan covenant reports that tend to be more lagging indicators. For bankers who rely heavily on those, why is that not quite as effective as they may think and more of a lagging indicator of a deeper problem?
Absolutely. By the time they hit the past due reports, the financials will probably reflect very much evidenced weakness, which means, one, there may not be a refinance option out there. And two, you may not have risk mitigating efforts available, such as, let's use SBA guarantee. If you have fiscal year end financials have below 1.0 debt service coverage, too late. So if you can catch it early, not only are you helping the bank mitigate and probably reduce some loss exposure, but also help the borrower and maybe give them some options, such as different types of refinance or stretch the amortization and other types of tools that might be more palatable before the evidence is there that the financials are too far gone. So sometimes we can wait too long.
I
Yes.
for one, do believe that if you wait for the past due report to identify who your problems are, you're already putting yourself in a vulnerable position.
Yep.
Yeah, for sure. And Michael, you've kind of mentioned that there are, indicators before you get to that point that banks should be looking at. And I won't ask you to give away that full list, but what's one that might surprise a lot of lenders?
Not doing vendor checks. In other words, we get inquiries from vendors all the time on our customers. Do we turn around and ask them, how's this borrower of ours paying you? We don't. That surprises me. And it's something that I think we can improve upon very much and stay more in tune with the vendor relationships, because that's one of the early warning signs.
You mean not just the accounts payable report that's internally prepared?
And get it once a year? Yeah.
Exactly.
Yes. Absolutely. A lot of banks feel like they have their three lines of defense covered, right? But where do you typically see the biggest crack in that armor?
Mm.
And how does beefing that up, so to speak,
Okay,
change the daily workflow for a commercial?
sure. It's easy to blame loan review or loan administration for problems. There can be problems in those areas, such as perfecting collateral. Um, that with newer hires, that's easily a problem. It's really easy to blame. I think you can go back to two areas that I think we can improve upon. One, better prospecting, better risk assessment early on so that we don't have a surprise later saying we've already knew this was a possibility. And then you can, by identifying the risk, you then quantify it and then mitigate it early. The other area, and this might be a little surprising too, that I think we can better, and that is in the loan review function. Banks pay a lot of money to third parties, especially hired large firms, sometimes the bank CPA firm. And I just have two questions, especially if it's a CPA firm. What do they know about banking? And then the second question is, are you getting your money's worth? Um, Again, it's there to not just ratify what the bank is doing, but how about this? Tell me something I don't already know. Help me grow the bank, help me grow the people, that sort of thing. Get more value out of that vendor relationship. I think that might be one of the bigger, I guess you mentioned, cracks out there.
Yeah, that's a good one. I think vendor relationships can be kind of tricky in that regard. Because like you said, not every vendor that a bank works with understands banking. Even, that's a
Mhm.
problem with marketing vendors
And the
specifically, in
regulators
my
have a lot
area.
of new hires, so you can't rely upon your regulators to help shape your risk management. They should just ratify. But again, there's a lot of folks that don't have a lot of experience. If they're a regulator with less than 10 years experience, they probably haven't really seen a workout situation.
Yeah. Before I move on, Brandon and Nick, do you want to add?
It has been a while since we've had a down credit environment. It's a, it's a very good point.
Yeah, no, for sure. I mean, that predates my time in banking even. So if, let's say we get to our link event uh in August in Ohio, and you present, and our listeners attend the event and they take, your guide back to their teams the next week. What's the first conversation you think it's going to spark between the lending side and the credit side of the bank?
Ooh, the first conversation after this presentation. All right. I would suggest to just open up the topic of how do we become more proactive in risk management? Then shut up, listen, and hear the ideas come from the staff first. And then, based upon that, that might align with what I'll be talking about. It also may deviate a bit or add to it. It could be an additive. So I would not just, um, I guess, force the discussion to what I'm presenting, but just use it as a catalyst for further discussions, but initiate the conversation about the topic with the staff right away. And then you can then build a program or enhance a program effectively that way.
That's good. Hopefully, a lot of good conversations are going to come out of your presentation, whether that's, about the specifics of what you present on, or if it's just a springboard.
Mhm.
But you mentioned loan reviews a little bit back in the conversation. You or Nick one did. But I think those can often feel like a check the box kind of necessity that we do for regulators. So what's one question a board member should ask during a report to determine if the bank is actually getting their money's worth from that loan review process?
How is the loan review process helping us with our strategic goals? That would be the suggested question from a board member. Since I have potential personal liability as a board member, I really want to know how aligned it is with our goals. And those are things that I deal with more often. I'll defer to the other gentlemen as to their input on this. Great question.
I really don't have a question on that. That's well said. I think that's the biggest takeaway is what's my risk?
Right. I mean, you're paying money for this service. What's the best way you can maximize it and make it work for you? It's not just a process that you have to go through. You know, how do we get the team aligned to understand that there really is there's a benefit for everyone here, because it takes good teams to keep good loans good.
Yep. And keep your eyes wide open.
Yes.
Yeah, for sure. I think that's great insight. So I have one final question, and that is, why should our Ohio bankers come hear your presentation at our Link event in Ohio?
Well, number one, the networking opportunity. That getting together is getting rarer and rarer. So the in-person events are just precious opportunities to build a network of true peers. And then the idea exchange. And with idea exchange, sometimes you need a catalyst of, oh, I never thought of that. Then you start talking to others and they may not have thought of that. And then you start talking about, maybe we should be talking about that. So I think that's the best value I can see of these live events, because there's just no substitute for that networking and the humanistic factor of exchanging ideas on the fly.
Right. And on top of that, they get to hear all of your wisdom. So, I mean, there's really no downside to be had there.
No.
Right. Well, Michael, thank you so much for joining the podcast and giving us a little bit of a preview of the presentation you're going to give. I think it's going to be really good and really helpful to a lot of our bankers. I know you plan to incorporate some more local and regional insights, so it'll be very tailored to what those bankers are seeing. So I really hope that those listening can make it. And Brandon and Nick, thank you for joining the podcast as well. They're also two who are very knowledgeable and will be there. So I really appreciate your insights as well.
Thank you all.
Thanks for having us. This wasn't as painful as I thought it would be.
I try to make it painless.
Yeah, that's right.
That's what you got. Thank you for listening to the Correspondent podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.